Thank you. So let's just go through the outlook. Financial markets data. Okay, we're not going to focus on this, but please, you have to continue to monitor the markets. Okay, because most of the basic data from the analysis that you're conducting is going to be off-price data. And it's either going to be oil or gold or stocks or bonds or a foreign currency. So you got to continue to monitor the markets, and I will ask you occasionally, you know, what the market did, where interest rates are, where's gold, where's oil, where's the dollar. Okay. I'm going to go over the memo format, but I'm going to do some of the trades. I'll probably skip over that pretty quickly, but I still think that you need to understand how to make the derivative trades based off of your view. Okay, and I'll go over the report format. I'd like to do the statistical pretest, but if it's redundant, I won't spend that much time. I'd rather get into the lecture to set the foundation. I'll assume that you understand the difference between skewed and binomial and normal distributions, covariance, variance, standard deviation, that you know how to build a model, that you know how to identify independent variables, you know how to test independent variables with dependent variables, you know the problem of multicollinearity and how to solve multicollinearity and how to reduce the forecast model down to get good T's and F's statistics, to be able to then build a forecast model, back test it, forward test it, and then be able to come to the board of directors with a recommendation of implementation and policy recommendations. You know all that stuff?
Yeah.
Okay. And then I will focus more on program applications and getting into the theory along with the mathematics and the programming around the chapters. I do want to go through and talk about, because the macro environment, particularly monetary policy environment, has a direct effect on everybody and everything. Doesn't matter what industry you're in, it's going to have an effect on the stock price, the bond price, your cost of capital. When the Fed does something and we move into a recession, you're going to be impacted. So you have to be monitoring monetary policy and understand the tools, particularly open market operations. Interest rate determination. Interest rates are in, or the risk-free rate is in every single model that you're looking at within the book. It's in every model in valuation finance and valuation decisions. So you got to understand how interest rates are determined. What is the yield curve? I'll go through the theory, the dynamics of the yield curve. I'll show you some dynamics because they have a direct effect. The Fed is managing the yield curve. It's managing the cost of debt and equity. And if the Fed makes a mistake, which it may have already made, we could be in a recession within the next 9 to 12 months, which we may be if we're not in one already. And that's going to have a direct effect on all of us and our models. The cost of debt and equity. How do you determine it? What's the theoretical model behind that? And if interest rates are going up and down, then the cost of debt and equity is going up and down, which means that bond prices and stock prices are going up and down, and the value of your firm at the enterprise level is going up and down. Okay, it has a major impact. How do you determine, and for a lot of companies, it doesn't matter if you're public or private, you have a balance sheet. You have to have an optimal or a target capital structure that's going to minimize the cost of capital, or what's called the weighted average cost of capital, which is the discount rate that you use when you're discounting back the cash flows on investments that you're thinking about investing in. And you have to get to the capital structure. Then lastly is, how do you make those investment decisions? And I'm using investment decision making matrix that I designed, and I actually designed that matrix with and without real options. And real options, they're discussed in the book. I have real options materials here, and real options are actually used both practically and theoretically by all firms and senior managers. Okay. So getting into the memos, again, please continue to focus on the asset classes. If you think, if you're forecasting, you built your regression model and you built a forecast model, you are predicting the price of any one of these assets, let's say, to go up. Well, if you think they're going to go up and you can support it, and you can test it, and you can validate it, you will be buying forward contracts, buying futures contracts, buying calls on futures, and writing puts on futures.
There's pen right there.
You're going to buy the calls on the futures, and you're going to write the puts on the futures. On the exchange traded funds and the stocks that are highly liquid, traded on the exchange, you can profit by buying on margin, borrowing money, buying on margin, buying the call options, and writing the puts. Those are the trades where you are going to benefit from the prices going up, or if you are on the cost side, where these are inputs into your production process and costs are going up, this would be the hedge that you would make. To offset rising costs, you would be doing these trades to offset those rising costs and those exposures. If you think that prices are going to go down, you're forecasting them to go down, then you would write the forward contracts, write the futures, buy the puts on the futures, write the calls on the futures. On the exchange traded funds and the stocks, you would sell it short, you would buy the puts, and you would write the calls. Those are the trades. The way that the memo was set up was here was the trading mechanisms. Here was your thesis statement that laid out what you were tracking, over what period of time, up or down, by how much, and why. This is the why. These are the technicals, 1-inch margins, everything's flush, bolded, 16 points. The format is very precise and it's very specific. Okay. Then for the report, you're going to have your basic front memo of the report, which is going to lay out what was the problem that was brought to you, what's your recommendation, boom, right off the bat. You tell me the recommendation. And then you tell me later on what the problem was. Here's the solutions. Maybe there's some output here, and then you tell me again. Very quickly, you want to get to the recommendation, okay? Because the board of directors and senior level managers know that you're experts in your field, and your recommendation is going to be taken at face value, okay? But you got to tell me right off the bat what the recommendation is, and how we're going to benefit from it. Then you have your cover page, what's the project, what's the product, the corporation, the team's names, the date. Then you're going to have the executive summary, and here in the, you lay out the body of the document. The headers of the subject areas that are provided you should be in bold, and probably 14-point type. The subheadings could be in 14-point, but they need to be bold and italicized. So the report is laid out and reads just like a report. If there are key takeaways within the report, you want to bold those statements, and those statements end up becoming the executive summary. It's the key takeaways. So if you're a senior level manager and you need to make decisions, I can get my decision or almost make my decision just by reading the memo. I walk away with the key takeaways just from the executive summaries, and a lot of these people are not going to read anything past the executive summary. Okay, they're going to leave it up to the analysts and others and people who are really interested in that area to read the whole document. Okay, so then you got your sections. You're going to have your references on the back. I highly recommend, because a lot of the networking and the options trading and the credit risk management, there's a large body of literature, of seminal articles that are peer-reviewed with all of the other references in the back. So if you can reference 3 to 5 articles that support your approach and your recommendation, you now have external validity to your model and your recommendation. And then the appendix page, and then you may want to put graphs and tables in the back of the report that, again, when the manager is reviewing either the PowerPoint or the report, they're going to say, oh, where is the graph that shows, well, it's in the appendix on page 17. So you can drive them right to the page, and you have the evidence. So it answers their question, so you can move on. Okay. All right. So the statistical pre-test, again, the 2 key areas there is really model building. Internal, external validity, variable identification, regression testing, either in a cross-sectional or time series manner, being able to diagnose the regression results, build the best model, alleviate the multicollinearity or heteroscedasticity that may be embedded in your model, and then be able to, once you get the model, you back test it to make sure that it works. You forward test it on a trial basis to make sure that it works. Once the model has been tested, back tested, and then it has internal and external validity and support, boom, you can get the recommendation to move forward on the implementation. that's basically what the pre-test was supposed to do, was to bring you up to speed, not only on the statistical technicals, but also, do you understand how to build models, and do you know what internal and external validity is? Because it's really important that you have both, okay? I will go into more detail on the programming side with the programming software. Basically, if you look through the books, there's overlapping content, and it's on time series and financial econometrics, portfolio theory, optimization, capital allocation line and security market line in an efficient frontier context, asset price models, trading and valuations. And again, you're using big data, so you're using large data sets, and you're running this in continuous time. Equity and fixed income models, duration, immunization, hedging, value at risk. That's a big component now for all firms. Term structure and interest rate determination, which I'll go through. Risk premiums, how do you measure them? How do you build a discount rate? That's a big deal for a lot of companies, is what is the discount rate and how do you build it? You got to decompose it and figure out what it is and how it's built. And those need to be programmed too. Capital asset pricing model, we'll go over that, and the weighted average cost of capital. Derivatives, and using them for hedging purposes, hedging off credit risk on the liability side of the balance sheet, and how to use options, and option pricing, and option valuations. Big data, extreme value, transformations, matrix algebra, networks, number theory, event studies, and being able to use and implement simulations to simulate different types of environments that Scott was talking about earlier. Any questions so far? No? Okay. Let's talk about, let's stop it and